For years, Melbourne's property market has been the black sheep of Australian real estate. While Perth surged by 17.1% the past year and Brisbane rose by 10.4%, Melbourne's value fell by 3.3% over the past 12 months. But here's something you might not expect. This underperformance has created what could be Australia's most compelling property opportunity right now. I spent the last 3 months analysing Melbourne's market fundamentals, and what I discovered might surprise you, especially if you've been avoiding Victoria because of the recent headlines. Let's start with the hard facts. Melbourne's home values record their 10th straight month of decline in January, down by 0.6% for the month. Since peaking in March 2022, Melbourne's values have fallen by 6.9%, or approximately $58,000 in dollar terms. That's a significant underperformance compared to the other capital markets. But here's where it gets interesting. Despite the price drops, sales volumes has been increasing. The 2% decline in values over the past 3 months is the largest rolling quarterly fall since January 2023, suggesting we might be approaching the bottom of this cycle. So why has Melbourne underperformed so long? So I want to give you 2 critical factors that stand out. First, the economic setbacks. The extended COVID lockdowns left a lasting damage on the Victorian economy. In 2022 to 2023 alone, 7,600 businesses went under, a clear sign of economic distress. The state government policies, including the mental health levies and COVID debt levies on businesses, further dampened economic activity. Second, investor disillusionment. Stricter tenancy laws, higher land tax, and rising holding costs push many investors to look elsewhere. This creates a self-reinforcing cycle of underperformance. But here's the thing about property markets. They operate in cycles. And after a prolonged stagnation, they typically enter strong growth periods. We've seen this exact pattern happen in Perth, which delivered just 1.2% annual growth for 15 years before exploding upwards to 17.1% in the past year. Current data show Melbourne is undervalued by approximately 300,000 compared to its long-term trend. This type of deviation doesn't last forever. So then, what's changed? Well, several critical factors are aligned to create a perfect storm of growth. Supply is contracting dramatically. There are currently 63,700 dwellings under construction in Victoria, 11% drop from last year. High-density apartments projects have seen the sharpest decline, while detached housing construction is down by 19%. New dwellings approvals are 14% the 10-year average, and 2024 completions are projected to be the lowest in a decade. Meanwhile, demand is surging. Victoria recorded a population increase of 183,000 people in the year to March to 2024, the highest of any state. Interstate migration has turned positive for the first time since 2020. Housing finance commitments in Victoria have reached $86.2 billion, 13% above the 10-year average. The rental market tells the same story. While CoreLogic data shows Melbourne's rents have turned slightly negative over the past 6 months, down by 0.6%, this is primarily in the unit sector. The broader trend of a 4.4% national rental increase suggests pressure is building, especially with Melbourne's vacancy rate at just 1.5%, well below a balanced market of around 2 to 2.5%. Perhaps the most surprising news is Victoria now leads Australia in economic activity with an output of 7.7% above its 4-year average. Strong retail spending and business investments have pushed Victoria ahead of New South Wales, Queensland, and other states. The Victorian government has also introduced new policies to stimulate the housing market, including stamp duty reductions for off-the-plan purchases since October in 2024. But here's the most critical point. Not all Melbourne suburbs will perform equally. There are cycles within cycles. I have identified specific areas showing the strongest growth indicators. Take Dallas in postcode 3047 for example, with a current median house price of $525,000. Rents alone have increased 12% in the past year. There are only 5 listings in the market, which is insane, and this represents just 0.24% of the housing stock. The days on the market is down to 29 days. And to give you context, if it's below 40 days, it's a sign of a booming suburb. Auction clearance rates is 83%, which is super high. These are the exact same indicators we saw in Perth growth suburbs 3 years ago before the price doubled in value. Now, I'm not suggesting Melbourne is without risk. The outer suburbs with high supply like Melton or Tarnee should be avoided, and investors need to be selective about which areas they target. But for those willing to take a contrarian approach and focus on the right suburbs, Melbourne presents a rare opportunity to buy at the beginning of a growth cycle rather than at the end. So what's your next move? If you're considering Melbourne, focus on areas with these following qualities: low listing volumes, decreasing days on market, rising rental yields, strong auction clearance rates, and limited new supply in the pipeline. I love to hear your thoughts on Melbourne market. So have you been avoiding, or are you seeing the same opportunities as I'm seeing? Drop your perspective in the comment below. If you're serious about capitalizing on Melbourne's potential growth before prices start climbing, I can help. My name is Wilson Yuan, and I specialize in identifying growth opportunities while they're still flying under the radar. Book a strategy call with me through the link below. We'll analyze your specific situation and discuss whether Melbourne suburbs align with your investment goals. In my next video, I'll be covering an area of Australia I've identified as a hidden gem for investment that no one's really talking about. So make sure to subscribe because you don't want to miss it. Thank you for watching, and I'll see you in the next video.